should you buy Apple stock if you don't already own Apple stock? I'm going to answer that question in this video, looking at the various critical financial metrics for Apple, including the prospects for the forward free cash flow expectations, its valuation utilizing my discounted cash flow model, looking at revenue growth, return on invested capital, and looking at valuation on a forward price to earnings basis, bringing it all together and answering whether or not I think this stock is a buy, hold, or sell for 2025. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I mentioned the stock price at $250 a share. That's up from around $80 a share in 2020. Of course, I'm happy about that. I've had Apple stock rated as a buy for a couple of years now, and I own Apple stock myself. I've owned Apple stock since probably 2014 or so. So I've got nice gains embedded in my Apple stock position. But coming into 2025, if you're a new investor that doesn't already own Apple stock, let's see if it makes sense for you to buy for 2025. First thing I want to look at is revenue growth over the last few years. And on a trailing 12-month basis, Apple's revenue growth has been relatively flat for a couple of years now. $391 billion in trailing 12-month revenue. That's about where it was at in 2022 when it generated similar amounts of revenue. Apple's revenue growth has slowed down as the replacement cycle for smartphones has also slowed down. People are holding on to their smartphones for longer. However, one good note of development in the smartphone industry is that more people are opting for more premium smartphones. And that's good news for Apple because Apple is the premium smartphone in the market today. And so more people are upgrading from the lower end smartphones to the higher end smartphones, and Apple stands to benefit from that as a result. This is fueled by the increasing capabilities of the higher end smartphones, most specifically and most recently, the enhancements with artificial intelligence. So this could drive incremental growth for Apple here in 2025, although that incremental growth is not likely to be significant. I don't think Apple will benefit anywhere near, let's say, double-digit growth or something like that. It will be single-digit growth for Apple, most likely in revenue in 2025. But that's not necessarily a bad thing for Apple. The company is such a cash machine. It generated $118 billion in cash flow from operations in a trailing 12-month basis. But again, that's about the level it was at around 2022. In fact, it's lower than peak levels of cash flow from operations generation. The company experienced a huge boom in 2020 and 2021 as people who were getting stimulus checks from the government, they had more money in their pockets. They had fewer things they can spend money on. So they went out and bought smartphones and tablets and laptops and desktops. And all of those purchases of electronics were great news for Apple. That being said, since people bought so many of those electronics in 2020, 2021, and 2022, those are long-lasting goods. They last several years. So that's created a bit of a growth vacuum for Apple over recent years. Now, the reason the stock price is increasing, one of the reasons the stock price is increasing is because investors are optimistic that when those devices get older and they need to be replaced, that's going to develop into a nice replacement cycle for Apple where they'll get a surge from sales from people replacing those devices that they bought during the pandemic. That's starting for a small part of its business, although it hasn't been this fully fledged replacement cycle that's driven huge increases in Apple's sales or cash flows. Now, one of the reasons I've loved Apple stock for so long is because the company is so good at generating returns on invested capital. You can look back at this metric for a decade, and they've done an excellent job in generating returns on invested capital. It's all the way up to 54% now. And they've been great at doing financial engineering, as I like to call it, utilizing the capital structure, utilizing lower cost of debt, borrowing more money, and then buying back shares of stock, increasing the dividend, and thereby reducing the equity in the business and increasing the debt in the business. And you might say, well, how is that a good thing? Well, it's really I don't want to get really wonky into these advanced finance topics. I teach this in my university course, and so I don't want to get too deep into it in a YouTube video. But what I will say is when you're financing a business, there's two ways to finance a business. You can either finance it with equity, which is money that you already have, or you can finance it with debt, which is money that you don't yet have and you borrow it. Now, of these two financing sources, debt is the lower cost source of financing because when you're financing your company with debt, the person that's giving you the money, the person that's lending you the money, is promised a rate of return, let's say 5% or 7%. And regardless if your business does very well or your business does poorly, they're going to get that 7% or 5% or whatever was promised to them. So they're willing to accept a lower rate of return in exchange for the lower risk, in exchange for more certainty. And so businesses that can increase their financing, increase their sources of financing towards debt, can have a lower cost of capital. And when you're a company as large as Apple with great business prospects, you can borrow at low interest rates. And so that's helped facilitate this improvement in the company's returns on invested capital. And overall, the management team has been excellent at managing the capital structure, returning capital to shareholders, not wasting money on various projects that don't turn out to be successful. They've been really good in terms of their batting average on the things that they invest in and the results of those investments. Now, looking ahead, the analysts on Wall Street expect Apple's free cash flow to grow from $109 billion in 2024 up to $189 billion by 2029. So the analysts on Wall Street are optimistic about Apple's free cash flow growth over the next 5 years. That flat cash flow that you've seen from Apple, the chart that I showed you for the previous couple of years, is expected to end starting in 2027. So their fiscal years 2025 and 2026 are expected to be relatively flat in terms of free cash flow growth, uh, growing to 123 billion in 2025 and then to 131 billion in 2026. So there is growth there in free cash flow, but the bulk of that growth is going to come from 2026 to 2029, where their cash flows are expected to increase from 131 billion to 189 billion. Again, that matches up with that thinking that they're going to benefit from that replacement cycle of electronics that were purchased during the pandemic. Looking to valuation, Apple's stock is getting stretched. It's trading at a forward price to earnings of 30, which is near the higher end of where its stock has traded for, according to this metric, going back a year. And in fact, if I go back 3 years, this is the highest the stock, in the range of the highest the stock has traded for going back 3 years. But that's just one way I look at valuation. Another way I look at it is by doing a discounted cash flow valuation model. But even in this discounted cash flow valuation model, the results suggest that Apple's stock valuation might be getting stretched. It's trading at $250 a share, and the intrinsic value per share is $161. So whether I look at the forward PE or the discounted cash flow model, Apple's valuation looks to be getting stretched. So to answer the question, should you buy Apple stock if you don't already own Apple stock? Well, the answer is no. I'm actually downgrading my Apple stock rating from a buy down to a hold, and I'm updating that recommendation on January 1st, 2025. I still think it's a great company. I'm not going to be selling my shares because I've got a large capital gains embedded in my shares. And so if I were to sell, I would have to pay a lot of tax on that. And I don't think the stock is ridiculously overvalued. I just think that it's getting stretched. And so if I was thinking about putting new money to work, Apple would not be the place I would put it. There's many other companies I like better than Apple stock right now.
Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.